a trade just because of what this year was. Everybody's always fighting the last war. 2008 happened. The banks crashed. Can't be in banks ever again. So now the banks had a bad year at the beginning of this year in February. So now the banks are going to be bad forever. It's like, no, there's always a trade to happen in areas, especially after everything's washed out. It's like saying, like, hey, you can't buy Bitcoin because the FTX thing happened.
That's the time to buy Bitcoin. Go back
Yeah.
and look at the chart.
Yeah, that was the perfect time. So it's ridiculous to say things like that. Like, that's the washout that we want to see.
I want a crisis with my bottom, right? And that's exactly what you got with the banks this year. So sentiment couldn't be better.
I don't care how good you are in anything, you don't have discipline, you ain't nobody.
Right.
You're nothing without discipline. Because you give up on the slightest struggle without discipline. Discipline is doing what you hate to do, but do it like you love it.
You want to know how some of the best traders are positioning themselves in 2024 and what they are seeing in the markets today? Today, I'm bringing on my buddy, Steve Strazza. He has been in some of the largest companies you can think of in the brokerage world, Morgan Stanley, Interactive Brokers. He has also been the personal accountant for Steve Cohen. He comes from an interesting background where he was actually an accountant. And today he's moved on to being a full-time technical trader. He reads the charts like nobody you'll ever see. He brought a ton of charts for everybody to look at today. We go through everything from what's going on right now to how this crazy rally happened to what you should look for to profit going forward in the future and how to look at charts and how to read charts, all the way to what we are seeing going forward in 2024. I hope you guys enjoy this one. This was a lot of fun for both of us. We both really enjoy this, and we'll talk soon. Hey everybody, we're here with my buddy Steven Strazza. Steven's from All Star Charts. He's the director of research at All Star Charts. He's also on Stock Market Media. You guys are gonna want to check both of those out. How you doing today, Steven?
Doing all right, man. Getting ready for Christmas. How about yourself?
Good, man. It's holiday season is here and everybody's behind, which is normal. But we'll see how it goes. I'm excited to have another fun year with the family at the least.
Isn't that just a part of it, though? The holidays, just being behind on everything, rushing around, trying to get everything done before.
Being behind, being confused, family arguments, it's all part of it, I think. It's all part of it. What about you? You got anything fun planned?
We learned to love it. Yeah, I'm driving up, and the whole family's doing Florida Christmas this year.
Nice.
So
Ooh,
I'll be up in South Florida.
that's awesome. For you, it's up. So jealous. You live in the Keys. That's awesome. Up in South Florida is not a thing most people can say.
I say I'm going to Florida, and people get confused.
Mm.
We forget we actually live in the same state down here sometimes.
It's just better in the Keys. That's all. It's much better in the Keys.
Yeah, we have a good time down here. Relaxing.
Mm-hmm.
It's like a trader. It's like a trader's paradise. Somebody who works at home, right? Doesn't need to be near a big city.
Mm-hmm.
Actually, perfect. It's very lovely.
No, it's about my favorite times are working out in the Keys. Like I can remember all the even the trades on the boat. Like not even trading on the boat, but looking at your positions on the boat. Man, it's cool, and it's the most beautiful area. I think I remember how I started going there. We do trips there every year. You know that I've told you that before. How we started doing that is I went down there to do a bike show in Key West at the base. At
Right.
the Navy base. And we went down and I did never seen anything down there before. I'd never been down there before. And all of a sudden I get down there and I'm like, this is beautiful. I want to come here all the time. I came back, I grabbed my fiance. It was like, we're going to the Keys. And we've gone every year ever since, man. It's awesome.
Yeah. You get that saltwater therapy because you're just surrounded by the ocean.
It's needed, man. So speaking of waves, let's start hopping into the charts, man. I know you got a great chart deck for us, as always. Let's hop into it. Let's figure out what's going on here because I know so many people are looking at the markets right now, trying to figure out what's going on, fearing the rallies. I don't know how that's even a phrase, but fearing the rallies. So what are you seeing here? What's kind of sticking out to you these days? What are you looking at, especially here, man? This is wild. Home builders, home construction. So that's ITB, XHB, in the ETFs. What are you seeing here?
Let's start with the leaders, right? What are the strongest ones doing? Well, what they should be doing in a bull market, making new record highs. So this is the homies, about as pro-cyclical as it gets, right? Call them economy stocks. They're offensive in nature, kind of group that you want to see leading. The first back to new all-time highs for the most part. Another one you hear a lot about, the semis. Cleared those highs from late 21, early 2022. So back, above overhead resistance, blue skies ahead. You could look at something like industrials. When it comes to the sector spiders, this is XLI, new all-time highs. Here's what's more important to me. When you get into the later innings, the later stages of a bull market, and I'm not saying the latest innings, but just not the early innings anymore, you absolutely need, it's a need, not a want, for the rally to broaden. And we're talking about breadth and expansion and participation. So it's great that the leaders look good, but guess what? They've looked good all year. Here's what the worst ones look like. This is online retail. Any of these long duration growth equity indexes, monster reversal patterns that have been forming since the beginning of last year. Right, so this isn't some sort of V-shaped bottom in these kinds of stocks, and you can put ARK in the same category, right? It's a prolonged rounding bottom, textbook trend reversal pattern. What does it suggest to us? Well, if you take it from left to right here, you have a downtrend, you have a sideways trend, and then as this level gets cleared, this is a clean one, that's why I brought it along. As this, breakout level gets cleared, what it tells us is a brand new bull market is underway. The path of least resistance is now higher. The trend has shifted. So it's still early innings for the worst ones. We were talking about the Russell 2000 and other charts that look like this one here, just in October at their range lows. Now we have these beautiful reversal patterns. Here's another one to drive that point home. Does it get more speculative than the IPO index, right? Nice reversal. Discretionary stocks, nice reversal. You could throw like ARK W or ARK into this conversation. Let me find it. I brought a lot of charts, Jason.
Oh, I love it. I love it. I mean, that's what I want to do, man. I want to pull out the charts. I want to cut through the noise. I don't want to sit there and talk about the news. I want to see what's happening because we don't get paid for what the news is saying. We get paid from the chart moving up. That's what we get paid.
You know what they call it when the market goes down and journalists don't know the reason?
I saw this today, so you could say it.
They call it a technical correction. I'm looking around yesterday, everybody's talking about this technical correction. I said, what else would it be? And then I realized, oh, okay, they can't explain this one. So it's a technical correction. Listen, when there's periods of volatility or things are unexplained, right? Unexplained sort of price action, they always look to the chartists to explain why. In good times, nobody wants us. But when things hit the fan or we have a tiny little intraday sell-off like we had yesterday, and they want the technicians. It's a technical correction. So I thought that was interesting.
No, it's funny. I think of people who I've known in the fund industry over the years that'll be like, oh, that's parabolic. And I'll be like, they've never looked at a chart ever, but like something they want to get out of, they'll start looking at the chart and come up with a reason why. Like, oh, it must be parabolic. And they're like, look at this. And you're like, well, you never look at technicals before. Why are you looking at it now? Same with a V bottom. Oh, huge V bottom, time to buy. Whatever they're thinking at the time and however to quantify it for themselves in their own brain, they're gonna say.
People seem, so when I say people, talking about sentiment, it seems as though everyone is just looking for a fade here. Right? Like we had this monster move off of the October lows after 3-4 months of selling from the summer. to late fall. And then a huge move higher. We had breadth thrust, momentum thrusts. Everything's kind of triggering, saying green light. And when you look at these charts, Russell 2000, ARC, again, fresh bases, just resolved higher. So it's hard to think, okay, the trend just reversed higher, and now you're looking for a correction. You want to sell. This is literally, for anyone with a long-term time frame, this is the optimal entry as soon as the trend reverses, right? So what would make me more cautious or make me change my tone right now? All of these bases that we just went through, IPO, the ARC, Russell now, mid caps look similar. If they start coming undone, falling back into those old ranges, okay, fine. That means maybe more basing, but already based for a long time. Don't be surprised. And if you look at something like the Russell 2000, I have it right here. This is a really clean support level. I'm sorry, this is the small cap 600. Very similar, small cap index. Right into these pivot highs, right? And we've been here for about a week, kind of chopping and churning around. That's corrective, right? So if tomorrow we were to blast right through it, shouldn't surprise anybody. It would just be another one of these completed bases.
No, I love that because it's in general when you've read the technical books. What's his name? Stan Weinstein. You got the stage 1, stage 2, it's like this is as textbook as it gets as a technician to understand that we're starting a new bull market. Like we've already started it in tech. It's already been there all year long. And everybody said you can't buy tech. There's only 6 stocks moving up, and then they called it the Magnificent Seven, and all of these things. And really, it's like, no, like that's kind of normal off of a bottom. You have tech leading the way. Tech was pretty beat up. It got beat up for a long time, more than anything else. And then it starts to bottom, starts to come up. January 2023, all of a sudden we start to see it running, has a little pullback, but it's stronger than everything else on that pullback. The relative strength was wild in tech at that time. Banks, everything get crushed. Tech is holding up. Then tech leads the way. Nothing else is catching up to it. But how many times have we seen that same scenario? Like, when are people going to start waking up to that being a possibility? 2020 was even the same thing. Tech leads the way. Then everybody goes, there's no possible way we're out of the bear market. And then we get into, finally the election happens in 2020, and then the rest of the stocks catch up into the end of the year. It's almost the same playbook over and over again. It's kind of laughable when you think about it.
This is such an important discussion. Are you a basketball fan, football fan?
Oh, yeah. I play it every day.
So you play. You play on like a team of guys?
Sometimes.
Okay.
Some years.
When the best players on the team score most of the points, do you guys all sit around and look at each other and complain that it's only 3 players scoring all the points?
No, because if you did that you wouldn't understand your role, right? You have to understand your role and you have to keep playing. And not to mention, like, if you're a kid and you're in that and you're in high school and you start to complain about the dude who's taking all the shots and the coach is giving them the green light and not you, you're just going to get pulled out of the game. So you know that you have to do your job, play defense, play hard, do what you do well.
And you could argue the rest of the market was playing some good defense by not falling apart while the leaders were doing their leading. The Magnificent Seven, you hear it thrown around all the time. What is it really? These are the biggest, most badass companies in the world. And they're doing the best. It's not only is it not a bad thing, it's not an abnormal thing at all. It's actually quite common. We're starting to see now just an expansion and participation in a big way. Talked about these reversal patterns in some of the weaker or lagging indexes, right? So they're playing their catch up now, but the big boys let it off, and that's completely normal, right? Also, I think it is important to take a step back and remember, what was the big buzz this year? It's AI, artificial intelligence. Who benefits the most? Well, AI is expensive, right? Doing things with artificial intelligence costs money. Who have the biggest pocketbooks and the smartest employees and the most resources? These big tech companies, right? So they're the ones benefiting. I think when you really take a step back and think about it, it makes plenty of sense that we did see that leadership. People complain that it was a thin market, right? Which means not enough stuff was participating. those people who are complaining about the thin market have no argument left, right? Because we have seen breadth thrusts over the past several weeks that some we have never seen. So we have data going back about 30 years for overbought momentum readings. Never seen a reading so high. I think it was 47% last week. Almost half of the S&P 500 index, half of the components in the index had overbought momentum readings. Last time we saw anything close to this was early June of 2020 off of the COVID lows, right? Acted as a huge propeller for the bull run that ensued into 2021.
That it's wild, and not to mention, this is the thing that drives me crazy about technicians or new technicians. Sorry, people who've been trading for a while. You understand that overbought can always become more overbought. Things going up isn't always a bad thing. Like being overbought isn't a bad thing. So most of the time when you see a reading like that, that just means yes, things might slow down for a minute, things might consolidate, but most of the time when things are in an uptrend and it's that strong with that much momentum, it's going to continue. The only thing you're really going to see is flag patterns because it's usually going to consolidate and go even higher. And those times that you pointed to, that was exactly that. June 2020. We had that massive spike in tech, and then it had that crash for, I think it was like a week or something. Everybody's like, it's the end again, and then it just went right back up. Yep.
So here it is. So I went back and
you got it. Nice.
Everybody was freaking out yesterday. I said, okay. And I continue when I'm flipping through my breadth charts and our breadth workbooks these days, keep thinking of May and June of 2020. Some of the most epic, breadth thrusts we have ever seen. So I went back to June when we had, so June 8th, 2020, 43% of S&P components overbought. 3 days later, on June 11th, the market fell. S&P 500 fell almost 6% in a single day. What were we down yesterday? 1.5%, 1.2%? I don't even know. It wasn't 6. Everyone freaked out and panicked. It's highlighted in yellow here. Market literally found its floor the next day, reversed it, and rallied 60% over the following 18 months. So it's context. It doesn't mean that's not a back test. I'm not saying it happens like that again, right? But if the market tanked 3% yesterday, wouldn't undo the breadth thrust that we had the week before, right? So
I find it absolutely insane as a trader, and especially in my time frame, that so many people like panic about things like that. Like it's insane to me. I know, like, I have had great returns over the years. I know if the years that I panicked like that when I first started trading and would be like, oh, gotta get out. Look, it's pulled back hard. Like it had a 1 day pullback. Like one, there's a couple things. One, that's ridiculous. Two, that means you're trading way too large. If like this 1% pullback is like killing you, you're trading too big. Something is wrong with the size of whatever trades you're putting on. So you have to, like, number one, think differently. Like, how do you hang on to a trend like you just mentioned, 60% trend? How do you hang on to it? You look at it, there's plenty of pullbacks of that same size. So you'd have to be able to handle, if you can't handle 1%, you're certainly not handling 10%. There was 10% pullbacks in there. And after that, there wasn't many, but you got to catch a huge, massive trend, 60%. Like, so how are people going to handle that if they can't even handle a 1% pullback?
And you don't want the market to move in a straight line higher, right? It's typically not sustainable. You start hearing the word parabolic thrown around, usually not a good thing, right? You want a nice leg higher, some digestion. Maybe the digestion looks like that. Another leg higher, some more digestion, right? Like you want something orderly. And frankly, we've been running numbers internally. This is how I know it's a bull market. We are running numbers internally to see what some of these overbought streaks. And when I say overbought streak, I mean a stock enters overbought range. So the daily RSI 14 above 70. And how long does it stay above 70? Typically, Jason, I don't have to tell you, you get overbought, maybe it stays overbought for a day or two, dips back out of overbought, maybe back in, right? Stocks got overbought back in November and are still overbought today.
Mhm.
We're looking at streaks that are going on 5-6 weeks now in some of
Mhm.
the strongest individual components. This is unheard of,
Mhm.
right? So this is as bullish as it gets. You're seeing the momentum come into the market. You're seeing the breadth expand to other groups. Next year is going to be a lot different than this year. And for active market participants and traders, this is what they call stock pickers market, right? The indexes probably won't lead anymore. Magnificent Seven takes a break from leading, which is fine and healthy. And then you look beneath the surface, and there's pockets of strength everywhere. So there's more and more opportunities in individual names and individual sectors and individual industry groups, right? Uh, uh, 2023, as much as the market has been strong, could have just parked your money in the triple Qs or SPY and had a really good year, right?
Yeah.
I think next year you probably want to stay away from the indexes. You're going to get that outperformance as you move down the cap scale, out on the risk spectrum, and it should be a lot more fun for traders, I think.
Yeah, and I think the thing that you bring up too, which is how many people, you have the situation, right, where you have the triple Qs going up like crazy. You have people then going, well, I can't buy that. I don't really like tech. Like are we traders or are we, speculate like are we just speculating on things for the hell of it? Like if we're traders, we have to really be in line with this is moving up, this will make me money. I don't care. I watched
Yeah.
somebody talk so much crap on you know, people buying Apple and Microsoft this year. It's like well, they made money. What are you talking crap on them for? It's a phenomenal trade. Great. Who cares? Like these things have gone up. That's how we make money. We buy the things that go up.
And there's a lot of them these days. I was talking to you offline. I think people are snoozing on financials. They're completely done with the cyclicals and the value groups.
Mhm.
I mean, these stocks have to eventually participate in a sustainable market. I think materials, industrials have already been working. You're going to see more of it, right? Next year,
The
watch the
banks.
financials, watch the materials. If you don't have exposure to banks, it is the most irresponsible thing you could be doing right now.
Mhm.
These banks look so good. International banks, money center banks, regional banks, community banks, crypto banks, all of the banks, investment banks. We put a trade on Wells Fargo yesterday. JC and I were laughing to each other. Said, as long as I've worked with JC at All Star Charts, we have never been bullish on Wells Fargo.
Yeah.
It's information.
Yep.
And, I think another important point too, anybody who's interested in that kind of a trade, there's been a big shift. I would suggest this one. This is the Bible, John Murphy, Intermarket Analysis. He
Ooh, one of
talks
my favorites.
all about the inflationary regime and how intermarket relationships might change when the inflationary dynamics change.
Mhm.
We think of banks as stocks that do better when rates are rising.
Mhm.
It's no longer the case, right? We had the bank panics and the regional banking crisis in Q1 and into Q2 of this year. There were bank runs in the United States,
Mhm.
literally just in the first half of this year. Interest rates cooling off and coming down is actually a really, really bullish thing for the banks right now. You saw banks rip as much as real estate companies, the ARC long duration equities, right? All of these super interest rate sensitive groups were working, and the banks are working with it higher as rates are moving lower. That might be something different for a lot of people, so that's important to keep in mind.
Yeah, especially as we're seeing the banks come out of inversion. The banks have trouble when you have the yield curve inverted. Of course, they borrow from the short end and getting paid back on the long end. So now we're seeing that change too. And if you look over the last 6 months, where's the relative strength? XLC Communications is number one at almost 13%, and right behind that at almost 13% is XLF Financials.
Yep.
So XLK and XLE are the two behind that. So it's like, what type of regime are you kind of seeing? And that's the thing. Like we have to, for Wayne Gretzky quote, skate to where the puck's going.
Yep.
Where's it going? Well, I kind of see a more, like you're saying, towards cyclicals, a more reflationary style regime. Banks are obviously showing this relative strength. Energy is trying to show some relative strength. It gets kicked every once in a while, but it's trying to show some. Industrials look great. What an amazing breakout that we're seeing, that you already showed already. And then let's look at XLB. That could be another one. All of those areas could be phenomenal coming up into next year, while everybody's kind of now gone, tech is great. And for me, yeah, tech was where I wanted to be. I actually went back to your show that I was on the other day just to see, like, JC asked me a question. I thought he asked me a question. What did I think was going to be the best trade into the end of the year? And I
Yeah.
said tech. And, that was when tech already ran so much and everybody would have thought I was crazy for saying that. And it was still tech, and it's been tech. So now I'm kind of seeing, like, most of the time I know that trades like that do go on for about a year.
Yep.
Relative strength begets strength. We know that. That's what we trade on. But seeing now where the strength is kind of flowing into, I think you're right. I think you're completely right on what you're thinking.
We talk about how trends persist all the time, but it seems like when people start doing relative strength analysis, they forget that trends persist. So just like any other trend, right? And there's a real like money flow dynamic there in the sense that institutions, fund managers, hedge funds, they chase performance, right? So you say strength begets strength. Yeah. And you're seeing probably the biggest chase that I can ever remember in my career into year end here. You have some very powerful forces at play over the next week and change. Window dressing is a real thing. The Santa Claus rally. Santa Claus may not be real, but his rally is. Like, there's some real stuff going on. Dollar seasonals. It's the worst week of the year coming up for the US dollar index based on seasonals. Last week of the year. Strange. Why? Because the last week of the year also tends to be one of the best week for risk assets. And those two tend to go hand in hand in opposite directions, right? Let's talk more about relative trends and what to expect for next year.
Yeah, no, I'd love to do that. And like, I really like the banks thing. I mean, I put on the banks trade the other day, and I didn't say too much about it, and that's kind of cool that we can kind of cover that here, because I've been seeing that we got the signals for it, the relative strengths coming in, but once again, it's something that, like, I kind of glanced over because for me it was like, yeah, like you, it's obvious, like, okay, but like, really thinking about it, a lot of people are gonna hate that type of trade just because of what this year was. Everybody's always fighting the last war. 2008 happened, the banks crashed, can't be in banks ever again. So now the banks had a bad year at the beginning of this year in February. So now the banks are going to be bad forever. It's like, no, there's always a trade to happen in areas, especially after everything's washed out. It's like saying, like, hey, you can't buy Bitcoin because the FTX thing happened.
That's the time to buy Bitcoin. Go back
Yeah.
and look at the chart.
Yeah, that was the perfect time. So it's ridiculous to say things like that. Like, that's the washout that we want to see.
I want a crisis with my bottom, right? And that's exactly what you got with the banks this year. So sentiment couldn't be better. I heard a stat the other day, and I don't overthink these things, the positioning stuff, but hedge funds have their lowest exposure to financials in like 7 years. Great. More sentiment, right? Supports the price action that we're seeing. So don't make too much of growth versus value. What do you think of this chart?
I mean, for me, I really don't fuck with the growth versus value thing, to be honest, and saying it very bluntly. In general, I think
You're lucky.
it's, yeah. I try to stay away from it. I try to not get into the debate too much just because I know what's in these ETFs. However, I do look at it. I do see that still here, it's like what you're pointing to is quite interesting because that could be wild if we see this kind of run into this resistance zone and turn down, and then value starts to run again. That we saw a really good run in value in 2021 and 2022. We saw a really good run, and that bottomed with tech and everything. So I wonder where that's all going to head.
The problem with the growth versus value analysis, and first of all, I think it's way overdone because we tend to, when I say we, the collective market analyst world, right? We tend to look at this growth versus value relationship as it's one or it's the other. No, not really. And a lot of times when you're analyzing growth versus value, you're doing it with indexes like these, and I did this on purpose, that are cap weighted. So a lot of times you could remove the numerator, in this case, it's the Russell 1000 Growth Index, I could plug in the Magnificent Seven, and it would show you the exact same thing, right? It's being driven by that cap-weighted effect. So if the best stocks continue to outperform and breadth isn't great beneath the surface, it's going to look like growth, 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 growth. What we're seeing over the past, I don't know, 4 or 5 weeks, month and a half, 2 months, as Magnificent Seven has kind of cooled off and let other stocks lead, it looks like we're moving heavily into value, but really what's going on beneath the surface is it's just moving out of the biggest winners and it's moving into value, sure, but also smaller growth, more speculative growth, right? ARK is growth. We talked about the reversal pattern in ARK. It's also completing a reversal pattern on relative terms, right? Indicating you could expect these speculative growth stocks to start leading over longer time frames. Trust me, ARK stocks are not value, right? But they're going to catch flows as that money moves out of the leaders, or there's some profit taking, and then it's sprinkled into other groups. It's a really bullish thing. So don't think of it as growth versus value or growth or value. I think next year it's going to be growth and value. It's just not going to be the growth stocks that they talk about in the news every day.
Yeah, I mean, it could be the small cap growth. That happens a lot where you see value start to trend with small cap growth. There's a bunch of ways to look at all of those style factors, but really, we've seen this massive run in the biggest names, large cap growth. Really, it's just large cap growth. If I really go to my style factors chart and just look at it, I'm sure that, yeah, like large cap growth is heavily outperforming everything, and that's the way it's been. So it's continued to be that large cap growth while everybody's kind of looking wonder. I mean, really, if you look at the style factors, all the value or growth, the only one that's really doing well against the S&P year to date is large cap growth. That's it.
Because it's large cap growth versus large cap growth. The S&P is a large cap growth fund.
Yes. So it's the biggest of the biggest is the only thing kind of holding up against it. But if you look closer and we look at the 1 month time frame, you're seeing some interesting stuff. Small cap core is up 8% to the S&P 500. Small cap value is up 8.5% to the S&P 500. Small cap growth is up 7.3% to the S&P 500. So, I mean, all of those are kind of starting to happen, starting to pick up some steam. So that's going to be to me, that's where the money is made. Like looking at the last 3 months, seeing where the relative strength is in the last 3 months and going, okay, those are the areas I'm going to want to really look at. Like small cap values, small cap core are the best ones in the last 3 months. Stay on that. Keep looking at that. Probably small cap value being the leader out of that one.
Small caps are really waking up. Mid caps haven't been terrible. So they're leading small caps. The cool thing about mid caps is they're kind of like in a sweet spot where what people don't realize is that market cap is a quality filter. In other words, for you to grow your market cap and get larger, you have to do something right. If you IPO as a $300 million company and you're a crap company, you're never going to leave small cap land. So to leave small cap land and enter mid cap land, you did something right? Your market cap grew. So you must be some sort of quality there. So that mid cap sweet spot, which tends to be between like 2 and 10 billion, is a really nice place to go fishing, right? Because typically you don't have that same like non-profitable issue that is so big in the small cap arena. Once they get to mid caps, they tend to be like viable companies, and it's a much better universe to kind of look for opportunities in. We're seeing things like biotechs, community and regional banks work. A lot of these small industrial plays are working. A lot, like I said, the speculative growth stocks are really working. When you look at the IWM SPY ratio, it reflects that strength beneath the surface in all those groups, where the Russell 2000 for the first time in, I don't know how long, 3 years, is showing some meaningful momentum relative to its large cap peers. So I think this trend persists and is probably something we're talking about come this time next year, right? Oh my gosh, look at those small caps. Tom Lee came on, and I just love this guy. Tom Lee came on one of the networks the other day and said small caps are going to be up 50% next year.
Mhm.
And got laughed out of the room, mocked on social media. That's it? Only 50%? So they're going to do less next year once they catch those rotational tailwinds than the NASDAQ 100 did this year?
Yeah.
NASDAQ's up like 60% this year. It's
I
not for
think so many people want to discredit big calls like that. I mean, because we're basically looking at, hey, this has been underwater a long time. This is just exactly what we just talked about the NASDAQ, right? We just said the NASDAQ got hit pretty bad in end of 2021. It was the underperformer in 2021. And then comes into 2022, it gets hammered way more than everything else. Then it comes off of a bottom, and it's the same thing because I put on the trade at that time. We started getting signals at that time. Even myself getting the signal, I looked at it and said, damn it, really? The NASDAQ? And I put on the trade, because I know I don't know shit. That's the first thing I always go on. I don't know anything about the markets. So therefore, I should listen to my systems that I built. And so, boom, we have this amazing trend, And so, what's the difference with the small caps next year? We have the same exact setup, coming off of a bottom, just like we did last year in October for tech. Now we came off the bottom here in the small cap space.
October.
Yep, perfectly. Perfectly. So right in October, now we're coming off the bottom. Now we're breaking out. Why not? There's no reason why that couldn't happen.
Again, right, 50% sounds like a lot, but it goes back to what we were talking about, at the top of this call. These bases are just right now completing.
Mm-hmm.
They've been range bound, trendless all year, right? So it's been very hard to make money over any longer term time frame in something like small caps, at least if you're playing it from the index level. The base just completed. The reversal's underway. Early innings of a new bull market. Yeah, 50% is not crazy at all, I don't think. And
No.
when we talk about this rotation down the cap scale, I guess I should, disclaimer, it doesn't mean that the Magnificent Seven stops rising. They just stop leading. They stop outperforming in a ridiculous way like they did this year. The performance gap between the best Magnificent Seven stocks and everything else this year was kind of absurd. I had a performance chart. Maybe we can throw it on in post production.
Mm-hmm.
I have a performance chart that shows Mag 7, S&P X Mag 7. A week or two ago when I was looking at it, if you remove the Mag 7 from the S&P was up about like 5%. That's crazy, right?
Yes.
So I just think, don't throw out your mega cap growth stocks. These are great businesses, great companies. If you're a long-term investor, never throw them out. They're so good, right? Just prepare yourself for a world where you're not ridiculously outperforming everything else around you, right? Maybe prepare yourself for taking some profits in those names because they were great trades or did really well for you, and then sprinkling some into other groups. This is Mag 7 versus equal weight tech, making new multi-month lows, having, if you look at the upper pane, that's the weekly rate of change. So it's worst week on a relative basis in over a year. You're seeing a little bit of a tide change, in market internals.
No, I love that. And it's something, you have to think about as a fund. Like what we do is go like, hey, we're still in the NASDAQ right now, and some of these other names are coming in, banks are moving in. All these names are kind of coming in, and we trade the sectors so we can trade banks and all that stuff. So as the signals start to come in, at some point tech will come out, like there'll be a sell signal, it'll hit a stop, something, and then all of a sudden you'll have the other ones take over. That's how you do the trade. You don't just get out because we think blank. We're talking about projecting forward. There's a world where these continue to go up and then nothing else goes with it. There's a world where these continue to go up and small caps go with it, and maybe small caps outperform. And most likely that's kind of the scenario we're seeing as a setup right now, is that Mag 7s, maybe they keep going up and maybe the NASDAQ keeps going up, but small caps are going to be the place where you're going to wish you were. And that's the difference. And even looking at like 2021, you know, like if you look at it, you'll see that um energy, banks, industrials, these were leading the way by far that year, you know, and then tech was the major underperformer. Didn't mean that tech went down, didn't mean you lost money investing in tech. It just meant it didn't do as good as these other things. And that's kind of more what we're seeing, which in 2020, tech was the outperformer. Then in 2021, it wasn't the outperformer. Could be the same thing for next year.
And I think the intermarket is going to matter a lot for what leads and what doesn't. Like, you know, this big move off the October lows didn't happen in a vacuum. The 10-year yield is off almost 120 basis points. That makes a big difference for a lot of risk assets, and some a lot more than others, right? We talk about the real estate, the banks, the long duration stuff, right? Because that's just, they punch that into their what do you call it? DC, what do they call them? DCMs. It's kind of cash flow models. When rates are higher, the cash flows that you make tomorrow or sometime in the future are worth less today. When that discount rate is lower, and it's based off the risk-free rate, so the government bond rate, when that rate comes down in a big way like it has over the past 2 months, then those cash flows from the future are worth a lot more today. So you're just seeing these stocks get repriced, these growthy stocks. So I think you have to watch interest rates. We don't want them cratering lower, but hey, it's not hurting right now, right? What you really don't want to see is a big, you know, mean reversion move higher. I think that probably spooks a lot of people, gives us more than just a digestion, probably a meaningful correction, which will probably turn out to be a buying opportunity when you zoom out. But that's what I'm thinking about over the short term, right? Like, been taking some profits and been a little bit more selective in my new entries because I'm looking at yields here. The 10 years oversold for the first time since like pandemic lows from back in 2020. 10-year doesn't get oversold, right? Interest rates don't get oversold very often. So this has been a big move, and I think it would be prudent to remain open to the idea that we could see a bounce higher or some sort of counter trend rebound higher in rates that could put pressure on risk assets and maybe mess up some people's short-term outlooks.
Yeah, I mean, I completely agree. I would think, you know, just my models, my cycle models are really kind of looking at, you know, we've had that bond, we had a bond long from 2018 all the way into 2020. Then we were short bonds all the way until very recently with only one whipsaw. I mean, that was a crazy trend. And now we have this one we're kind of looking at and going like, well, you know, basically bonds are in this weird like 2 to 3 year cycle. And we kind of saw this downward cycle, and it was nasty, the nastiest one I've ever seen in the bond market. I don't know if I'll ever see another one like that in my lifetime. And I don't know if we're going to go right to highs, you know, a long time in the bond market. But I could see a scenario. I think that the scenario where it just continues to move up and bonds are strong for a little while, I think that's very likely. You know, that's very possible in this environment where the Fed's at, where the world's at. It makes sense that bonds could be a good place to be. But I'd still, just like you, I think I need to see more. I need to see it really carve out that bottom. I need to see it pull back and then create a higher low. You know, like there's a lot of things to think about in the bond market.
6 rate cuts next year, Jason, is what the Fed fund futures tell me.
I'd be very surprised to see 6 unless there was some sort of crazy crash or some sort of scenario that I can't see it right now, but it's anything's possible.
But that's a great point. No stock market or risk asset bull should be hoping for 6 cuts in a year. Usually not a good environment to be operating in, right?
No. I mean, I think people forget things quickly, right? 2020, they're cutting rates like crazy. They throw it to zero, infinity QE, you know, like if you would have bought like on the first rate cut, you would have been screwed. Like it still fell another 30%, you know? So I don't think that's ever a thing to hope for. I think the better thing to hope for is that it's kind of a dovish environment, kind of similar to maybe a 2019, where if there's any trouble, the Fed kind of comes in and helps. But really, like if you're thinking 6 rate cuts, that's a recession, that's a crash, That's a shutdown. That's a something.
It's definitely not the soft landing that they're calling it,
No.
as Fed Fund futures are pricing that in, right? It
They're not
wouldn't
just going to go in and start cutting because they think everything's fine.
listen. I think the more important information from the bond market right now is these two charts. The riskiest assets in every group, in every area, in every asset class, right, within each sector, it's the riskiest assets that are doing the best. You're seeing with high yield, junk bonds, fallen angels are just like the newest junk bonds. They're making new 52-week highs. They're completing bases that look like these bases in speculative growth stocks, right? So for bond traders, just like anybody else, play offense. You got to be on offense. And when we like to chart the high yield versus the treasuries because it's basically just credit spreads inverted, right? So it looks like risk assets. They are very much supporting the price action in the stock market. I overlaid it with the value line. I probably should have done Russell 2000 or something because it would show both of these bases resolving together. But the new highs shown in black in this ratio is the same thing as new lows and credit spreads, right? Credit spreads are making new lows. The bond market is telling you things aren't just good, things are great. Green light, right? Go buy risk assets. So everything we're seeing from an intermarket standpoint, whether it's rates coming off in the way that we've talked about, 115 basis points since October, dollar really coming off in a big way. It looked like it had completed a base earlier this year, then failed miserably. Now back below key levels from prior cycles in 2016 and pre-pandemic levels, around 100 and change, right? So Dixie below, say 102 is a tailwind. I think interest rates below 4%, tailwind. I think credit spreads making new lows is giving you the everything is really, really good out here kind of signal. So you want to pay attention to the bond market. And right now it's saying green light, currency market saying the same thing, risk appetite saying the same thing. Look at something like the crypto market. We could talk about that.
Yeah, let's see what you got on crypto. I agree with you though. Like this is the area to be and seeing risk. There's so much risk on here. All gauges are risk on. Let's look at the crypto because to me, that's what tells me a lot about risk on. And the thing that I can't understand why nobody ever seems to understand when the market's in a rough way, right? And you see crypto is moving up or hanging steady.
Yeah.
I can never find a reason to be bearish. Like it's happened so many times now, and I don't understand why people do. No, same thing. We go back to 2020 again and again. But another great example was that summer in 2020. What was crypto doing? Well, it was moving up. It was bottoming when everything else wasn't. So it tells us a lot about the market.
All right. I don't even know where to start with this one.
Ooh, I love that chart.
I know, like, to your point, I pretty much know what futures are doing on Monday or Sunday night, on Saturday, based on crypto, right? Like you said, that's some of the best risk appetite information that we have, and it never closes. The market's always open. It's fantastic, right? So pay attention to these cryptos. It does speak to the animal spirits, right, that you really want alive and well in a sustainable market. Let's start with this one before we go to Coinbase. At first, it was just Bitcoin earlier this year. Bitcoin booked a reversal pattern far earlier than pretty much anything else. This index excludes Bitcoin, right? It's Ethereum and the next 9 largest 3 years ago. And I've kept it consistent for a reason because I want the data, right? If I went and changed it to the top 10 by market cap today, which I get that question a lot, I would lose the data from 3 years ago, right? So these 10 are still some of the largest altcoins. So this is our ASC altcoin index. Looks a lot like ARK, looks a lot like the IPO index, looks a lot like small caps, right? The trend is shifting higher just now. If you look at something like Solana, well, leaders lead. Solana from 20, 30, 25 to, I think it's close to 100 today. This chart's a little bit stale. Absolutely ripping. It's what we want to see. When you look at crypto equities, Coinbase, we got into this in the 40s in January, trading around 160, 170 today. these things are doing so well. It's hard to think that it's a bear market when cryptos are mooning, right? That's what the kids call it. They're mooning.
Mooning.
Avalanche is a good one. The crypto or the Bitcoin miners are really waking up just over the past few weeks. Something like Mara or Riot, they look really good. I did this fun little exercise. Tell me I'm crazy. So I'm not saying that my target is $26,000 in Ethereum. I'm just saying if it went to $26,000, it certainly wouldn't shock me, right? Because the last time we had a textbook reversal pattern play out in all these big cryptos, Ethereum, Bitcoin, we rallied over 1,000% over the next year. So don't rule that out. When these assets are in uptrends, they don't go up a little. They go up a lot.
A lot.
A lot more than pretty much anything else, right? So if you are if your risk preferences align with this asset class, I mean, and you're looking for beta or as we call it juice, right? This is as good of an option as anything right now. Something like Ethereum that's just now completing a base. I don't know where it goes. My target is higher and my time frame is later, right? But for now, it looks great, and the primary trend is reversing. So I think it's so important to pay attention to these assets right now.
No, I love that because it's you nailed it, man. It's like these do not go up in a small way. It is not impossible for those numbers to happen. It's kind of like when people saw that breakout to, it'd be like saying like, yeah, I can't hit 60K from 10. Like it did. And it certainly can do. Like, why couldn't it hit 150 or 160 from 40? That doesn't make any sense either. Of course it could, you know?
So if this is a new sustainable market for crypto, right? Bitcoin's not just going to go back to those all-time highs. It's going to more than take them out.
Mhm.
So if you simply project the move that we had last time, a reversal pattern was completed, get around 163,000.
Yep. Easy. Easy.
Coinbase is another one we like. I think there's a even better lesson outside of the whole crypto theme in this chart. As participation broadens, we continue to see more and more chart patterns that look like this one in the upper pane. That's Coinbase on absolute terms. Been getting a lot of questions about, well, which ones do we pick? I can't buy all 100 or 200 or 300 reversal patterns. And yet you're right, and you shouldn't. A good rule of thumb is look for a reversal on relative terms too. So that's what's in the lower pane here, right? This is showing me that Coinbase hasn't just reversed its trend higher on an absolute basis, which means or indicates higher prices in the future. It's reversed its trend versus the broader market, indicating leadership in the future, right? So when I buy a chart that looks like this, not just on an absolute basis, but also on a relative basis, I'm comfortable in knowing, okay, the way things look right now, this one should be a leader in the future. So not only am I buying something that's rising in price, but hopefully I'm buying something that's outperforming. And that's really important, particularly for money managers who have some sort of a benchmark to beat, right? That's it. It's not just about the absolute trend. Look for that reversal in the relative trend too. That checks both boxes. Those are the ones that you really want to be buying. So Coinbase has been that for a while now.
I love that because that's the thing I think everybody's trying to figure out, right? How do you pick what to buy then? Like for me, that what I have a problem with is that I don't pick individual stocks, but I know a lot of people pay attention to my channel and pay attention to my stuff who do. For me, not picking individual stocks and being in futures, and once you have a certain amount of cash, it makes it very easy to pick many things. But when you don't have as much money and you're picking stocks, and it's you're basically 1-to-1 or one to 1.5. That's it. That's all you have. So you have to really have a system or systematic way of some sort to do it, and you just laid it out there. That's really cool. That's something that to really think about.
Every time you buy something new, there's an opportunity cost because that money is gone now, right? So that money being in this new thing that you just bought means that it can't be in something else that might be better than this thing that you just bought. So you want to always not just benchmark it against the broader market, benchmark it against the best stocks. What I was doing this summer, I was taking the growth stocks that I owned and the tech stocks, and I wasn't benchmarking them against the S&P. I was benchmarking them against the strongest group, XLK. Said, okay, are these stocks outperforming the best stocks in the market? I was benchmarking them against the Magnificent Seven index, right?
Yes.
That, man, if they're outperforming the Magnificent Seven this past year, they must be good, right? So don't benchmark it against small caps or some crummy index. Benchmark it against the leaders, right? So make sure that you're in something that's poised to outperform and not just see higher prices, but see higher prices at a higher rate than anything else.
Yes, and when the one thing that and then anybody watching this, if you just ask me, I'll share it with you. The one thing that I've built, easy to build on probably your platform is Optima, mine, stock charts. Any of these you can build this on, but it's basically you go, okay, you go down the whole thing. You go, okay, well, let's say you have Coinbase. Or let's make it easier for me, which would be XOM. You have ExxonMobil. How is it performing against the S&P 500? How is it performing against energy itself? How is it performing against the strongest stock in the energy sector? You can do that over and over again and kind of build a systematic way of finding strength. Now, people hate buying the strongest of the strongest, and so there's another way to do it too, which is finding the things that are showing relative strength in the hard times. When you're in a bear market, think of 2020 as another great example. We keep going back to 2020. It's just easy. Everybody knows it. But if you're looking at that crash and you look at semiconductors, if you put a chart of semiconductors against just the S&P 500 itself, it doesn't even look like semiconductors even felt the crash of 2020.
They never skipped a beat.
They did not skip a beat. So that was where the strength was. And most people go, well, why would I want to buy the thing that fell the least? I want to buy what fell the most. That's the biggest sale. It's like, no, markets are not like when you go to the grocery store. If that was the case, everybody would make money. Markets are the opposite thing. Sometimes you got to buy the things that are higher than you'd want them to be because they're of quality, because some people are pushing that price up continually, and you want to be in that thing that's trending up, not down.
At the end of the day, the long-term trend is simply a reflection of the market's opinion on the fundamentals. Fundamentals don't change overnight. In other words, what's a company that you think is garbage? I don't want to pick on GameStop.
I don't know. Everybody thinks that I said I posted a chart about small caps, and somebody told me to stop posting about Ponzi schemes. So I don't know.
So if there's a chart that's falling for a long time on an absolute basis, and even more importantly, on a relative basis, right? If it's in a 5-10 year downtrend, and you're buying it and thinking that that trend reverses before it does, you're making the bet that something really significant changes in the fundamentals of that asset, right? And go look at Sears Holdings. Well, you can't anymore; they're gone. Go look at a Macy's or one of these brick and mortar retailers. The charts and particularly the relative trends have looked so bad for so long. It's a reflection of the underlying economics of the business, right? So if you're buying something that hasn't reversed trend yet, you're making a big bet that something very, very significant changes in the fundamentals of that company. And it's usually not the case, right? Bad things get worse, good things get better. And, that's why we follow trends.
Well said. Oh, we end it there, man. That was perfect. I can't think of anything better to end this on. Thanks so much for coming on, man. I think this is going to be really beneficial to everybody, man. This is you always come with some great stuff. Charts are the way you and I communicate, something we both love to do and talk about. So thanks so much for sharing all of your knowledge, wisdom, and just having a fun time, talk some real trading with me.
Jason, it's such a pleasure to come on with you. I'm such a big fan of what you're doing, coming out here, sharing your thoughts. You get out here, you're doing these podcasts constantly. Now you're doing the Twitter spaces. I think it's just what a treat, right, for investors to get to come on and see this content. So really, anytime you ask me to come on, I'm more than happy to. It's always fun hanging out with you and getting to chat markets. So thanks,
Dude,
man.
thanks so much, man. And make sure you check out Steven's stuff. We will put a link in the show notes, so make sure to check out all the stuff Steven is doing with All Star Charts and Stock Market Media. And we'll see you guys soon.
All right, bro.